Hello everyone and welcome to the YouTube channel of BeingACCA. This is Toshita Gupta, ACCA affiliate, and in this video we are going to be solving the section A from FM Specimen. This is available for free on your ACCA practice platform. I am dividing this test into small videos so that it is easier for you to watch and to understand this as well. So the first video will be all questions, 15 questions in section A. Then the second video will be the first OT case study from section B and so on. So without any further ado, let's get started. The first question is about foreign exchange. So the home currency of ACCA company is the dollar, and it trades with a company in a foreign country whose home currency is the dinar. So we are ACCA company and our currency is dollar and the foreign currency is the dinar. The following information is available: home country, foreign country, spot rate, interest rate, inflation rate, and we have to find out what is the 6-month forward exchange rate. So the spot is already given to us and it is given in terms of dinar per dollar. So that means our calculations also will have the dinar inflation or interest rate, whatever we choose to pick, will come first, and in the denominator we will take the dollar rates, right? So this is the first thing that we have to note over here. Now it comes to the decision. We know that the formula of the formula to calculate the exchange rate is going to be used. Now, which are we going to use, the interest rate or are we going to use the inflation rate? That is the question. So to decide what we are going to do over here is that we know that inflation rates are known to affect your exchange rates in the longer run. When we are only looking at a 6-month forward rate, that means this is very short term, and short term, the banks in the short term set the forward exchange rates using your interest rates. So that is what we are going to use. So let's start solving this. And right, so the formula is, the spot we have is 20. We multiply that by 1 plus the inflation rate of dinar. Sorry, the interest rate of dinar. So for dinar, which is our foreign currency, which is 7%. Now, please pay very good attention to the fact that this is per year and we are calculating the rate which is for 6 months only, because the 6-month forward exchange rate has been asked. So we are going to have to divide this divide this by 2, or you can say multiply this by 6 by 12 in order to arrive at the the interest rate which will be there for 6-month period. So 7%, if I half 7%, that comes out to be 3.5%. So 1 plus 3.5%, and I divide that by 1 plus, how much is the interest rate in the home country? It is 3%. So 3%'s half will be 1.5%. So if you work out this calculation, you will get your answer as 20.39 dinar per dollar, which is your answer. Now let's move on to the next one. Yeah. So question 2 wants us to find out the sensitivity of the NPV to a change in the sales volume. So we have to find out how sensitive is the NPV if there is a change in the sales volume. So this is something, where students get confused. Always remember that when you have to calculate it according to the sales volume, you will be using the contribution. So how we are going to solve this is, first of all, so the sensitivity will be equals to how much is your NPV? NPV always comes in your numerator. So 1300 divided by how much is your contribution? This is 24550, and I multiply that by 100 to get my answer in a percentage. And if you work this out, you will get your answer as 5.3%. So I will take 5.3% over here and move on. Now let's go to the third one. Gurdeep plots the historic movements to share prices and uses this analysis to make her investment decision. So first of all, let's read the requirement. Match the level of capital markets efficiency that best reflects each of Gurdeep's and Oliver's beliefs. So we have to match whether these are weak form, not at all efficient, semi-strong form efficient, or strong form efficient. So Gurdeep is using the historic movements and she is thinking that history will repeat itself, which means that she is assuming that the markets are not at all efficient, because even if they are weak form efficient, the historic patterns will not repeat. So she is assuming that it is not at all efficient. So we have to drag these options to Gurdeep. I'm currently using my pen, so that's why I'm not able to use my cursor to drag this to Gurdeep. And the second for Oliver, Oliver believes that share prices reflect all relevant information at all times. So that means he is thinking that, the market is constantly going to absorb any and every information that comes in the market. So that means he is thinking that the market is strong form efficient. So you will pick up strong form efficient from here and you will drop that to Oliver. With this, we move on to the next one. Which of the following statements concerning the capital structure theory is correct? So let's have a look. To answer this question, your understanding of the capital structure theories is required to be very good. Only then will you be able to identify which of the statements is right and which is not. Moving on to the first statement. In the traditional view, there is a linear relationship between the cost of equity and your cost of financial risk. Now this statement is not correct. Why? Because when we study the traditional theory says that your weighted average cost of capital rises with the gearing in the second phase. So if you read the BPP book about this traditional theory, so the WACC in the second phase rises with the gearing. So the risk is also increases. So if the gearing is increasing, that means the risk is also increasing. Now, if the risk increases, the cost of equity increases exponentially. Here the statement says linear relationship. Linear means that if it increases by 1 point, the cost of the financial risk increases by 1 point, then cost of equity will also increase by 1 point, which is not the case. If financial risk increases by 1 point, then the cost of equity increases multiple times. That's why this cannot be called a linear relationship. That's why the first statement is wrong. Now I move on to the second one. Miller, Modigliani and Miller said that in the absence of tax, the cost of equity would remain constant. Now, a lot of you will get confused and think that this is correct, but this is not the case. When we talk about the M&M without tax theory, so it is the cost of equity. So when your gearing rises, your cost of equity will also rise. But according to M&M without tax theory, it says that there will be no effect on the weighted average cost of capital, because these two effects, the cost of equity and the gearing, this will compensate for each other. So in net, there will be no effect. The WACC is going to remain the same. The cost of equity and the rise in your gearing will never impact your WACC, because these will equally offset each other totally, completely, so that there will be no impact on the WACC. Moving on to the pecking order theory. So this statement says that pecking order theory indicates that preference shares are preferred to convertible debt as a source of finance. Now, when we talk about the pecking order theory, according to this theory, this has given us the sequence in which it is preferring which source of finance to use. So the first preference is that you use your internal funds. The second preference is that you use your debt. Third is using convertible debt. Then fourth preference is using preference shares. And the last preference is using your new equity. New equity. So with this, we can know that preference shares are not preferred over debt. Debt is coming second and preference shares are coming fourth. So that is why the third statement is also wrong. Now we are left with the last statement, which has to be the answer, because one statement has to be correct. Now let's understand why this is correct. So business risk is assumed to be constant as the capital structure changes. So business risk, exactly, let's understand what business risk is. Business risk basically means the risk which is inherent due to the nature of the business, like the business that you do. For example, I work in the, let's suppose, cement industry, or let's suppose in a refinery. So in a refinery, there are a lot of risks that, my people who go into the mines to extract the oil, they are going to die. So this is the business risk which is associated to the specific industry where I work in. So capital structure does not play any role in deciding what the business risk is. Whatever those, my capital structure is, maybe I'm 100% in debt, but my business risk is not so much. So the business risk does not depend on any sort of capital structure. Business risk will remain the same as long as your business is remaining the same. If I am moving from another industry, maybe I did cement work and now I'm going into the paints industry, so that is when my business risk will change. Otherwise, capital structure is not going to impact my business risk. Moving on to the next question. Right. So which of the following actions is least likely to increase the wealth of my shareholders? The weighted average cost of capital is decreased by a recent financing decision. This will increase the wealth of my shareholders. Then financial rewards of directors are linked to the earnings per share. Now, this is something which will not increase my shareholder wealth. Why? Because, if the increase in earnings per share is going to be the criteria for the financial rewards for the directors, what they're going to do is they're going to emphasize on short-term profitability to increase the EPS currently, so that they also get their financial rewards, which will impact the business in the long run, because in short run, definitely there will be higher EPS, but in the long run, they will be sacrificing something to get this done in the short term, and this will not be good for the shareholder wealth. Moving on to the third statement. Board of directors decides to invest in a project with a positive NPV, definitely this is something which will increase your shareholder wealth. Then annual report declares full compliance with the corporate governance code. So whenever these results are, coming out for the companies in general, also if you see in the stock market, if the results of a company are coming out and they declare that the company is fully compliant with everything, so this usually gives a good impression to the shareholders, and the share price also tends to increase, thinking that the company is doing well, there's no compliance issues with the company. However, if you consider a vice versa case, in a scenario where it is declared that the company is not complying with something and there can be a case on the company, then the share prices tend to plunge in a day, and it plunges a lot in that very day where that decision is out. Moving on, so now second statement becomes your answer. Moving on to the next one. Which two of the following statements are the key features of your money market instruments? So money market instruments, basically, money market will be the market where people go for short-term funds. Capital markets are for longer term, and short-term funds are traded in the money market. So the first statement says a negotiable instrument can be sold before maturity. Now this is absolutely true, because it is a feature of the negotiable instruments that they can be like sold at the maturity, but you can also trade in them before they have matured. Now moving on to the second one, the yield on commercial paper is usually lower than that on treasury bills. This is not the case. Treasury bills are considered the safest instrument in the money market, because these are backed by the central bank, the reserve bank of the country. So these cannot be having a default. So commercial paper are more risky than treasury bills. So if you are taking more risk, then you will have more yield also. So the yield on commercial paper will be higher than that on the treasury bills. That is why this statement is wrong. Moving on to the third one, discount instruments trade at less value than face value. This is absolutely true, because as the name suggests, they are traded at a discount, and the discount is something which is less than their face value. So probably if the instrument is for $100, it will be trading in the market at 97, 98. So these are called discount instruments. Usually treasury bills are issued at a discount and then they are redeemed at their original face value. Now moving on to the fourth statement and understanding why that is wrong. Commercial paper is often issued by companies to fund long-term expenditure. This is absolutely wrong because this over here has to be short-term expenditure instead of the long-term one, because for long-term expenditure, they will be going to the capital market and not the money market. Moving on to the next one. Now we have to find out the operational gearing of G company. We have the information also given with us. So yeah. So we have the sales income, we have the cost of sales, we have the PBIT. So first of all, it's very important to recollect the formula of operational gearing. So operational gearing is equals to your contribution upon PBIT. So first of all, we need to find out the contribution for our numerator. So the contribution is equals to sales minus variable costs. So my sales are 60,000. So this is in these terms, and my variable cost is, so cost of sales is 50,000, and my number of units, so basically it is given over here that 60% of your cost of sales is variable cost. So that means the remaining part is the fixed cost. Now I only need the variable cost with me, so I'm going to take this into 60% because that is the variable cost. So this will be 50 into 0.6. Now this will give me my contribution of, right? So this is my contribution. Now I can find out my operational gearing. I have my PBIT also and I have my contribution also. So my contribution is this much and my PBIT is also given to me as 10,000. So this is going to be 3 times, which is the right answer. Now I will select this and move on to the next question. Now the management of Lamara company has, so first of all, let's see what we are here to find out. Calculate the annual finance cost saving if the management reduces the collection period to 60 days. So maybe their collection period is more than 60 days right now, and we have to find out how much finance cost saving will they make if they have, if they reduce the collection period to 60 days. So the information that we have given is that this is their credit sales, this is their receivables, and the working capital is financed with an overdraft of 12% interest per year, and we have to assume that there are 365 days in 1 year. So first of all, the very first thing that I have to do over here is that I have to find out what my current collection period is. So my current collection period will be how much is my the receivables at the moment. So my receivables are 4, and then my credit sales are 20 million. So 4 by 20, and if I multiply that by 365 days, I will have my number of days in my current collection period, which comes out to be 73 days. Now 73 days are my current collection period right now, and I'm thinking to reduce this to 60. So the difference that I'm going to have is of 13 days. So my cycle is going to, my collection period is going to reduce by 13 days. Now let's see how much cost will I save because of this. So because of this, I am going to save 13 days out of 365 of my finance cost, and I will multiply that by my credit sales to find out how much are my receivables. So this will give me my receivables of 712,329. So this is the amount of receivables that I will have. And then if I multiply this by 12%, which is my finance cost, I will get how much money will I be saving. So 712,329 multiplied by 0.12 will give me my saving, and my saving will come out to be 85,479. And I will input this same value over here. This will be 85,479, and this will be without any commas or anything. So this is how this will go over here, and we can move to the next question now. So This is question, the next one. So we have to identify which of the following statements about financial management is true or false. So it is concerned with investment, financing, and dividend decisions. This is absolutely true. Then it is concerned with financial planning and financial control. These are both these activities, financial planning as well as financial control, fall under the ambit of financial management. That is why this is also true. It considers the management of risk. That is exactly what we do in financial management. We are taking a look at all sorts of risks, the financial risks. Then it is concerned with providing information about past plans and decisions. This is not what we do in financial management. This is instead something that we do under financial accounting. That is why this statement has got to be false. Moving on to the next one. Right. So SCAWA company has paid the following dividends per year in the recent years. We are given with the dividends per share. So for the most recent one, it is 0.360. We have to find out using the geometric average historical growth rate and the dividend growth model, what is the market price of a SCAWA company share on an ex-dividend basis. So we have to find out the market price of the share on the ex-dividend basis. So let's do that. Right. So first of all, I have to calculate my geometric average historical growth rate. So basically using that, the formula that we have over there is that we will take how many cents is the dividend for the current year. Then I will divide that by the most previous data that I have, which is 31.1. And I raise this to the power of n minus 1. N is the number of years that I'm taking. So 1, 2, 3, 4. These are 4 years. 4 minus 1 is 3. So I will raise it to the power of 1 by 3 and subtract 1 from the overall figure. And this will give me my growth rate. If you work this out, you will get your answer as 5%. So this is my geometric average historical growth rate. Now using the DVM model, I need to find my market price of the share. So using this model, the DVM model, I have my formula as D1 upon cost of equity minus G. So D1 is basically nothing but the dividend which will be paid in the next year. So this is going to be 36 into 1.05 because 5% is my growth rate, and I will divide that by cost of equity is 12%, 12% minus 5%. So if I solve this, my answer is going to come out to be 540, and this will be my answer. So I can select this one and move ahead. Moving on to the next one, there is a risk. So we have to identify to which risk does the above statement refer. There is a risk that the value of our foreign currency dominated assets and liabilities will change when we prepare our accounts. So this exactly is what we have studied the definition of translation risk to be. Moving ahead, we have to find out the length of the working capital cycle. Everything has been solved and presented to us on a tray. So these are free 2 marks. Let's do this. So we have to find out the length of the working capital cycle. So and a very easy way to remember the formula is all of your assets, everything which is your asset is going to be added and everything which is your liability is going to be subtracted. So receivables collection period, receivables are my assets. So this is plus material, raw material inventory, again my asset, so add. Work in progress, again my asset, so add. And then payables is something which is my liability, so this is something that I'm going to subtract. And then the last thing which I have is the finished goods inventory, again a current asset, so I'm going to add. So if you work out this entire calculation, you will get your answer as 103. You will type this over here and you will move ahead. So the next question says, which of the following are usually seen as benefits of financial intermediation? So interest rate fixing. So usually this is not the benefit. This can be, this is the benefit in some cases, but this is not usual. So risk pooling and maturity transformation are definitely when you see a list of the benefits of the financial intermediation. Risk pooling, definitely. So financial intermediation basically means that there's going to be an intermediary. Maybe if you and I are dealing dealing in something, a bank is an intermediary. So the bank is pooling the risk. Maybe I make a default, maybe you make a default, but we are both protected because the risk is pooled, the bank is taking the risk. Then maturity transformation, again, I can always ask the bank to extend some maturity dates, and you can also do that. So maturity transformation are also something which are the benefits usually of financial intermediation. So your answer is going to be 2 and 3 only. Moving ahead. Which two of the following statements concerning working capital management are correct? So the twin objectives of working capital management are profitability and liquidity. This is absolutely correct. This is what we study. There is always a conflict, however, between these two objectives, but these indeed are the twin objectives of working capital management. A conservative approach to working capital investment will increase profitability. This is wrong, because when we are using a conservative approach, we are instead keeping more money with us. Keeping more money with us means we are investing lesser money outside, and that means we are not going to get those profits which we could have made on the interest that we could have earned from outside. We are putting in more cash with us, so that will decrease the profitability. That's why this statement is incorrect. Moving on, working capital management is a key factor in a company's long-term success. This is definitely true. Even if there is a very profitable company, it's making huge profits, but it does not have the cash, that company cannot sustain for a very long period of time. So this is also true. Moving on to the last one, this has to be false. Let's understand why this statement is false. The current ratio is a measure of profitability. This is wrong. The current ratio rather measures your liquidity, that how liquid are you? Will you be able to meet your current liabilities with the current assets that you have at the moment? Moving ahead. So governments have a number of economic targets as a part of their monetary policy. Which two of the following targets relate predominantly to monetary policy? So see, it's very important to understand that what these two policies talk about. So whenever we talk about the monetary, there are two policies, right? So the first policy is the monetary policy, and the second policy is the fiscal policy. So monetary policy is something which is determined by the central bank of the country. So the central bank in the case of India turns out to be RBI. For the US, it is the Fed, and so on. And the fiscal policy is the policy which is set by the government themselves. So the ruling government is going to be setting the fiscal policy. So what the government basically has with them is the revenues as well as the taxation. They have control on these two things. So the government revenue, which comes in the form of taxation, and the second thing, the cost that they incur, which is in the form of public expenditure. So these are the two things that government has their control on. And then the monetary policy has everything to do with the money supply. So with the money supply, how they control money supply, there are a lot of ways. So they control interest rates, they try to control the inflation. So there are multiple ways through which the central bank also controls the money supply. So always remember that when it comes to the monetary policy, it will always be about the money supply, and when it comes to the fiscal policy, it will always be about the government taxation as well as the government expenditure. So basically, if I see over here, which two of the following targets relate predominantly to the monetary policy? So the monetary policy will always be about your interest rates, keeping interest rates low, and talking about the money supply, controlling the growth and the size of the money supply. Both of these other points that we have over here, the tax revenue comes under fiscal, and public expenditure also comes under fiscal. That is why these both will not be the answer. With this, we have come to an end to section A questions, and in the following videos, we will be doing section B questions, one case study at a time. So stay tuned for the further videos. I hope that this was useful. Should you have any queries regarding this, please feel free to leave a comment down below, or you can also DM us on Instagram at BeingACCA. Thank you so much for watching, and I'll catch you in the next one.